Ladies and gentlemen, welcome to our session on California screaming. We are going to shortly move to a panel discussion, but wanted to give a little bit of background and introduction before we kick off. My name's Luke Fryer. I'm the founder and CEO of Harri. For those of you that don't know us, we are an end-to-end employee technology platform built for enterprise restaurant groups. We're based in New York, and we help our clients build their teams, manage their teams, grow, develop, and ultimately better retain their people to better run their businesses. We've recently crossed over 50,000 restaurants using our platform every day, and thrilled to be here. Nearly 5,000 of those restaurants are in California, so hopefully we have a degree of knowledge here. So let's recap why we're here and the kind of acute. Sorry.
There you go. Close to your mouth.
There we go. Better. Better. There we go. Alrighty. Let's start off with a quick recap of what's happened. Obviously, minimum wage jumped from $16 to $20 in April this year. That wasn't the kind of the 25% headline, wasn't actually the reality. There were a lot of local areas in California that had minimum wage rates over $16. There was an effective market rate that kind of took us above that. So 18% increase, still very, very significant. What was different this time around was really the sheer scale and the speed of the increase. Operators only had a few months to prepare. These kind of increases were usually tapered out over many years. Also, very important was the sectorial focus. Quite obviously very focused on the QSR sector. Very unprecedented, right? Never before has a single sector been selected for such a large scale of increase. Obviously, very large market, a lot of locations, a lot of employees impacted. So what's been the upshot? We're sort of just over 6 months past the change. The headlines, obviously very opinionated. But we spent the time to really try and separate out fact and fiction, and what we do, the numbers, the trends are very clear. Obviously, very significant prices passed on to customers. Employees have benefited, that's a great thing, but customers have responded poorly, right? There's been nationwide trend of a pullback due to inflation, but far more acute in California. So the drivers of this program will tell us that there has been no measurable impact on hours or employment. And the statistics, that's both from a Berkeley study and from Californian government, right? They're claiming a victory lap. But what sits behind that is a much harsher reality. And the fact is we're pressuring teams more than ever. The sheer quantum of the labour line has just put us our frontline operators under way more pressure. And the investability of QSR in California has been damaged for years to come, right? Anecdotally, I speak to many operators, they just don't want to open more businesses. They're closing locations and they're taking their expertise and investing out of the state, right? These are surveys at the moment, the numbers are clear, but what that really looks like over the years ahead, that's where the real damage, I think, will be evident. California, it's a little bit of a canary in the coal mine on many labour trends. And what we know is back in 2012, when the concept of a $15 minimum wage was first raised, it was actually kicked off by the SEIU in New York, known as the Fight for 15 campaign. That public conversation started in 2012, and California was actually the first state to implement the $15 minimum wage in 2016, quickly followed by California, and then it's proliferated across the country, as you see here, over the last 8 years. Now, if we draw that out and take a look at what that pattern might look like over the years ahead, you can see that this is potentially what could happen with the spread of a $20 minimum wage. Now, there's been a little bit of a slightly different reaction. There wasn't enough momentum to increase the statewide minimum wage from $16 to $18 in California recently, but the trends are persistent and obviously the conversation continues. With such a sharp increase in minimum wage in California, we wanted to sort of take a step back and say, what is the relative cost of labour across the country? We wanted to, with many operators, I'm based in New York, right? Even though there's a $16 minimum wage, you often have to pay well over that just to attract and retain talent. But this concept of affordability, a wage parity concept, started to sort of pique our imagination. And it was somewhat inspired by this concept of a Big Mac or a Starbucks latte index. What does this allow us to do? It allows us to look at a consistent product expressed in different currencies around the world, right? It's this economic term of purchasing power parity. But what if we applied that concept to labour and looked at it across the country? And so what we did is got on the phone and called hundreds and hundreds of restaurants and asked them, what is your starting rate of pay if I was to join as a crew member tomorrow? Because we have our minimum wage, and then there's the wage we actually have to pay in order to attract talent. We call that the effective market rate. We went to the website, we looked at the actual selling price of a basket of goods. And this is a McDonald's Big Mac medium-sized meal, a Whopper value meal, and a Dave's combo meal, all medium-size. Right, so very publicly accessible information, but we put the time into to study the market thoroughly. And what we're able to do is actually draw a correlation between that effective market rate and the selling price of that the average selling price of that basket of goods. And the results were very interesting. It turns out that Philadelphia is the most affordable market from a labour perspective across the country. Now, this is very relevant when we're operating a national chain of restaurants and trying to understand the underlying drivers of unit economics across the country. Now, obviously in California, we have a concentration of markets that are very expensive and difficult to operate. But for those of you from Denver, it won't be a surprise that Denver is actually the least affordable market in the country from a labour perspective. So lots to tell there. We'll be releasing this report, a lot more detail coming over the next few weeks. We've actually taken this out and looked at a few other categories, and we've seen some very interesting trends in pizza and coffee, but more to come on that. When we have an acute jump in wages, many of our clients are saying, look, what can I do to get ahead of this? And the reality is there's no silver bullet, and we're just consistently working through with clients to apply rigour across what we call the labour DNA. And it's these 7 key steps of going and consistently improving how you forecast demand, constantly focusing on optimising the deployment of labour, constantly working on ways to give managers time back to reduce applying automation to reduce grind, how we make sure that what actually happens is closer to what we planned to happen, right? Making sure we've got operational controls to reduce wage creep and what we call labour exceptions, and more than anything, driving to the deepest underlying cancer in QSR labour cost, which is employee retention. What can we do to improve employees' engagement and flexibility with their schedule and attack the broad spectrum of factors that go into especially sub-90-day retention, which is, in our estimates, somewhere between 15 and 22% of total labour cost is that sub-90-day cost of attrition. So I'm going to jump into our panel now and discuss some of these concepts in more detail. Thank you very much.
Thank you, Luke, for the insightful presentation. You've given us a lot to chew on for the next 30 or so minutes. For those of you who don't know me, my name is Nancy Luna. I've been covering the restaurant industry for 20 years. I've worked at the Orange County Register, Nation's Restaurant News, Business Insider, and I've been a freelancer at Food on Demand. So thank you, John Hamburger and Jared, for allowing me to present today. I want to introduce our panelists. We have Cosme Fagundo, operates 29 McDonald's restaurants in Northern California that he and his family took over from his parents in 2009. He is a dedicated and accomplished McDonald's restaurant franchisee who actively contributes to the broader McDonald's community by serving on the Technology Committee, Marketing Fund Board, and Government Relations Committee, where he drives innovation, shapes marketing strategies, and advocates for franchisee interests. And now we have James McGehee. Woo! He's got some super fans in the back. I love that. Bring your groupies.
That's her
All
founder
welcome.
back there, by the way, if you want to meet Armani's in the back row.
James has been the CFO of Dave's Hot Chicken since the Los Angeles brand started in 2019. He's also a Dave's Hot Chicken franchisee. He is a 30-year industry executive specializing in system implementations for growth companies, financial analysis, debt restructuring, and implementation of business intelligence systems to improve reporting and profitability. He is also a founding partner of the food service consultancy Results Through Strategy. All right. I want to start out with that controversial Berkeley study that Luke mentioned in his presentation that was widely reported by the media, not me. The Berkeley's Institute for Research on Labor and Employment found that the $20 minimum wage for fast food workers in California did not lead to large job losses or price hikes. From the study, they reported, "We find that the policy increased average hourly pay by a remarkable 18%, and yet it did not reduce employment. The policy increased prices about 3.7%, or about 15 cents on a $4 burger, contrary to industry claims of larger increases. About 62% of the increased costs were passed on to consumers in the form of higher prices." Okay, that's from the study. I want to ask you guys, starting with James, how does that compare to your reality?
Complete lies. Complete lies. No, so it is.
Yeah.
Look, we're a heavily franchisee-based company, right? We got 5 corporate stores. I have 3 franchise locations. Okay, we took $1 per combo. Okay, it's 8% price increase. Okay, and we needed to, right? We've got to protect our return on invested capital. We preach it nonstop to our franchisees, and we took 8%. We flowed through 6% of the 8%, so we were very fortunate.
And a lot of this, Cosmo, was happening well before April, right? I mean, this study, from what I understand, was looking at just prices 2 weeks before April 1st and 2 weeks after. So can you talk about
It's amazing how you can make data lie.
Tell us, Cosmo, what you had been doing ahead of to prepare for April 1st.
Yeah, so we started taking price in September. It was quite interesting being in the mix of the negotiations that were occurring. And especially the death grip that a special interest group, which I think all of you guys know who the special interest group is, has a death grip over California. But we took price over the entire time right up until April. So, but it's interesting how they did the study. They picked like 4 or 5 items. It's amazing what you do when you optimize for what the result you want is, right? So. They really only picked a few items, and I mean, they just bent the data. It's like, I mean, my increase is probably about 8 to 10%, depending on the
I was going to
restaurant.
say, what was it? And I think McDonald's overall in the nationwide prices were going up as well. So you were taking price on average, everyone nationally, and then on top of that,
Yeah, and in
in
the study,
California?
I think it said that we only had taken 1.7%. When you look at only a cheeseburger and a hamburger, that works.
So can both of you just talk about, specifically what you did besides price? Like, were you cutting hours, freezing positions? Can you talk about the labor aspect of what you did to help?
Do you want to go first?
Sure. I mean, look, on ours, we tried to make it as transparent to the guests as possible from a service perspective. We did not cut hours. We did introduce some of the technologies that everybody sees out there, like kiosk and things of that nature. But we didn't want to affect the experience, right? We didn't try and do shrinkflation with different food products where you're going from, a 4-ounce tender to 3.75. We're very fortunate. We've got positive traffic right now. We wanted to keep it there.
That's great. How about you, Cosmo?
I mean, we did what we normally do whenever we face, headwinds, right? We didn't really cut hours, but we tried to be more efficient with the hours, making sure that aces are in their places. That's a lot what we used Harri for. We had a lot of visibility, much more so than our previous scheduling software. So we actually put in Harri, I think, right before all of this happened. So we were very fortunate to already have it in place. But yeah, I mean, it's just about getting tighter on the controls.
Luke, maybe you can weigh in on what exactly, you are doing with your clients to help?
Cutting his price. Yeah, no.
Yeah, there's a big push to
Get closer.
Oh, sorry, I'm going to fix the microphone thing. There's a very, very surgical focus on deploying peaks, like really optimizing for peak deployment, like make hay when the sun shines, and absolutely optimizing through idle times. So clients really leaning on making sure that we're just not leaving any money on the table from a labour equation, from a labour perspective. Also, being able to predict employee retention, predict employee sentiment, and get ahead of retention, that's been two kind of key areas of focus where people are leaning on us in a different and a more acute way than they have before.
Great, thank you. I want to talk about the employees in general. Like, what's been their attitude towards the minimum wage? What are their expectations for pay raises over the next year? Has it changed employee behavior at all? Maybe Cosmo?
I mean, retention has definitely improved since we have a gap to the general market. And it has also caused a cascade effect in other industries where there's been labor pressure in other industries. We get a lot of hate.
Are you getting, what do you mean, like casual dining? Are you getting people jumping to?
I mean, even like Amazon. Right?
Oh, interesting.
So that's been interesting. In terms of expectation from employees, I think it's too early to tell. I think, they still expect raises from time to time, but I have not really heard like, hey, I want $30 an hour now.
It's coming.
So, yeah, don't say it out loud. Well, you hear that from SEIU. But yeah, I mean, my retention has gone from, so I had a trailing 12-month turnover of about 65%, and right now I'm at about 25.
That's not bad. Yeah. That's really good. James, how about you?
How much are you paying them? No, so, I mean,
How much are you?
I'll tell you guys, actually, when we were $16 an hour minimum wage, our average wage was $17.80. Right now at $20 minimum wage, we're averaging $21.05. So if you think about the spread there, right, $1.80 versus about $1, right, we have a compression going on right now as far as what the high earners, those key hourlies were making versus the person starting out day one, right? And I think as we go forward, you're going to continue to see this compression. I mean, I'm fortunate, right? I'm old now. I've been doing this for 31 years in California, and I got to see when we were going from 10 to 15, and it was like, oh my gosh, the world's ending. And now we're at 20, going to 21 shortly. It's just, this is all part of it. What I think is really interesting, though, because you touched on it perfectly, which is we're starting to affect the other industries, right? I've got friends that are growers, citrus growers, and he's like, man, you guys are killing my industry. I can't get people now. And there is a shift. There's a migration, just like growers would have the, hourly help shift from region to region to region. We're seeing the same thing to our industry. And it's pretty funny, actually. We just had we were just joking about it. Prop 33 was the minimum wage increase in California to 16 to 18. We both voted yes on it to increase the minimum wages, but it lost. So it's $16 an hour still. So.
Yeah, I was going to jump ahead and talk about, are you getting a different type of applicant now because of the minimum wage being 20? And you just talk about adjacent industries, like you talk about Amazon. Are you?
You do. I mean, look. I mean, there's many people in here. I see like 1986 fan, by the way. Good job. They're under 60 units, right? But I guarantee if you talk to him, he's going to sit there and say, no, we can't pay $16 an hour, right? I guarantee he's probably paying $18 an hour on average. So I do think that it does help with retention. To Cosmo's point, though, I mean, my turnover is around 70% in California, which is great. I mean, the industry was always historically 120 to 140 on the hourly side. So, I mean, we're at very low levels of turnover, almost too low. So you got to make sure that you're constantly evaluating the hourly staff. But as far as attracting, I wouldn't say it's attracting. Retaining, sure.
Sure.
Yeah.
It hasn't had the impact on full service dining that you'd sort of naturally expect. It's,
You're not
Get a grill
getting,
cook in LA, you're
Right.
paying
Yeah.
$25 an hour before, and that really hasn't changed a lot.
Yeah. And actually, just to elaborate, so my average crew rate was 1980 before this hit, and now I'm at 21, I think, and 2 cents, right? So, but I'm in some weird markets, right? Some markets that already had very high minimum wages. But I mean, it does show you even that small shift,
Right.
how much it impacted retention. So, and I haven't seen it necessarily an uptick in quality. We have a lot of people coming in trying to apply, which has made it very important to be much more selective when you do have somebody to replace. But to his point, the lack of turnover is getting to a dangerous point.
can you elaborate on that?
Yeah, I mean, like from an organizing perspective, it makes you a risk, right? But then, so it's very important to focus on long-term employee morale, which is, the reason for having a lot of these communication tools in place. The other piece of it is if you don't get the turnover at all levels, you do become kind of a dead end.
Oh, interesting.
So that is part of the danger.
There's another ripple effect I wanted to talk about. Let's talk about your supervisors and your managers. Now, with wages going up for the entry level, what does that do to your to the earnings for the supervisors and managers? Are you having to push their pay up as well? And
Yeah, no, I'll go on that one. I mean, we were already paying our shift leads well above minimum wage, 25 an hour. Our general managers, I mean, they all make anywhere from 95 to 105 because we've got the volumes to support them. So it's really nice from that standpoint. And our general managers typically bonus about 60 to 80 a year, depending upon the volume of the restaurant. So we didn't really have to move them up. And shift lead was well above already.
how about you, Cosme?
So I've gone through this so many times since I entered this industry. So I did not do any compression, but I think a lot of people kept the real dollar gap the same. I maintained the same magnitude, so by percentage. And that was meant also for retention purposes because, the closer you get to, you're going to want to go down in responsibilities if you're pretty much making the same amount or close to the same
Right.
amount. So that was part of the logic there. And I mean, my manager and supervisor turnover is, I think, right now about 5%, trailing 12 months. So, which is about 10% below where I used to be.
I will add one more thing for
Yeah.
fast casual, where you guys, if any of you take tips, right? I mean, we average $2.75 on tips per hour per employee, right? So if you think about it, $21 plus $3, $24, I'm starting to get dangerously close, where being a shift lead ain't worth it, right? I mean, the good news is the average person at Dave's that works full-time makes 50 grand a year, so it's not a bad living. Can't make it last that long, but.
Okay, I want to move on to pricing and menu adjustments and traffic. So prices are not just high in California. From 2021 to 2024, fast food prices have gone up roughly 19%, according to the latest CPI data. Chains have widely reported traffic declines, and as consumers have faced sticker shock at the drive-thru. And earlier today in the general session, I believe Andy Barish said that traffic has been negative for 2.5 years and got worse this year. And then we also heard earlier today that California traffic is down about 3.8% year over year versus about 1.8% for the nation. So customers are cutting back on visits and ordering fewer items, and now that's led to some value wars. And so can you guys address, starting with Cosmo, McDonald's brought in the $5 meal deal, apparently, how low traffic has impacted your restaurant, and are these value meals working?
So I'm going to take more of a industry look. So during COVID, supermarkets faced tremendous amounts of inflation, which caused a lot of consumers to run to us,
Yeah.
Unless you're in a fitness brand, then, they stayed home. But that, now we're facing the opposite effect, where basically supermarkets have stayed flat and our prices are going up because we're facing a lot of pressures, right? So the industry now needs to go back and grab the customers back from home and bring them back to the restaurants, right? Whether it be delivery, whether it be in store, whether it be through drive-through, it doesn't matter. So the value wars, as it's being labeled by the media, is there a market share battle? Yes, there's always been a market share battle, but now it's really a battle around the other industries taking our peeps, right? So that's part of the reason why we've deployed these meals and the campaigns that we have more recently, is to try to win some of that traffic back. So, yeah, has it had a positive impact on our traffic? Absolutely. Has it had a great impact on our margins? No, but in order for the long term, you can't make money if the customers aren't walking through your door, so.
That's a good point.
So anyway.
Good point. No, and it's interesting, right? You got the food away from home, you've got the C-stores, right, that are starting to come with more and more full-service offerings, right? You got, what is it, crunchy chicken or whatever it's called, and you've got fat burger you can get in a gas station.
Yeah.
It's fascinating to see how C-stores continue to evolve. At Dave's, it's kind of interesting. We looked at price value pretty early on, actually back in 2022. Real quick show of hands, who's been to a Dave's? All right, that's more than last year.
That's good.
All right. So, back in 22, we actually sat there and looked at our portion size, which was a half a pound of chicken per plate, literally. And I was like, hey, you know what? Maybe a quarter pound is enough, right? And so we actually came up with the combo number 4. The combo number 4 was a single slider and fries, go figure, following McDonald's footsteps, right? And so we ended up doing something that literally pulled our check down by about 2%, okay? But then ended up over the long run driving a tremendous amount of traffic. What we did, fast forward to, this year, we're also looking at it and saying, okay, portability. Can you eat a quarter pounder in the car? Not easily. I can, but not easily.
You're a skilled man.
I am. So, but we ended up coming up with Dave's Bites. Okay, Dave's Bites, 10 pieces with fries, right, for $9.99. So I do think that price approachability is a very important piece of our business. You do not want to exclude, consumers that need a value, which for fast casual, it's $10 or less. You got to have an entry point. That's just what it is.
Thanks. Can you talk about more like sort of the value perception too? It's not just cutting prices, right? Like it's not just a bundle meal, yeah.
No, look, value, this is the fun part of our industry. You can get value from a bunch of different areas, right? How the facility looks, right? The service levels, right? The quality of food, the consistency of food, right? All of these things add value to the individual consumer experience. I will say at Dave's, I'm very proud, our average customer sentiment right now is 4.7. Okay, it was not that 2 years ago. It was actually closer to 3.7. Okay, so we put a tremendous amount of effort on ops execution, and our ops team has done a great job ensuring that we deliver something that adds value to the guest experience.
Yeah. I've interviewed a lot of operators who say you can't just get through these wage pressures through just raising menu prices. You've got to find other ways to raise revenue and cut costs. Can you address anything? I know you've done some kiosk, or
Yeah,
can you
so
talk about?
there's different ways that you can drive check, right? Kiosk, we talked about it briefly earlier. We've been testing and rolling those things out, right? You get about a 6% lift on kiosk sales. It's not new news. What I thought was interesting is that if you take a look at kiosk sales as a percent of dine-in sales, for us, and again, we don't, not a kiosk-based company you guys have adopted kiosks a long time ago. But we run about 25% of in-store transactions go through kiosks. And it fascinates me because I like talking to people, right? I like calling people on the phone. But you get the next generation, which for us, it's 19 to 35-year-old dudes, that come in, and literally there'll be nobody in line. There'll be a person sitting there at the counter, and they'll be like straight to the kiosk. And that's my teenage kids, for sure.
Besides driving check, though, is it helping with the labor equation? Are they the question is, are they replacing employees?
No, I mean, for us, it's not about labor savings, it's about giving optionality to the guest, right? And then frictionless from their point of view, okay? For us, I'm not sitting here cutting a cashier, okay? Theoretically, maybe the cashier has a little bit more time to survey the dining room, see if there's anybody that needs anything, if there's nobody in line, see if there's a table that needs to be pre-bussed, things like that.
Adding value in different ways.
100%.
Cosmo, McDonald's has had kiosks for a long time. Has that overall helped reduce labor pressures at all?
We've shifted the labor, right? So it again, right, going back to where you can add value to the consumer, right? That was part of that equation. It's not necessarily about eliminating labor. As one of the consultants that's in here that helped us deploy that.
You got a lot of help here in the
A lot of help. But one of the things that I really kind of want to introduce into the conversation, right? You're right, price. You will always have to take price to accommodate for the pressure. One of the things that I think a lot of us forget, there's this equation in elementary physics, right, which is force is equal to the mass divided by velocity over time, right? Like,
oh boy.
If you hit a wall, it's gonna hurt, right? It's gonna be pretty bad. What's gonna kill you. So the same way in terms of when we get wage hitting us, right? It hurts and it could kill, right? So that's where you see a lot of the brands failing. Is because there was too much cost introduced too quickly. The same applies to the consumer, right? So if you hit the consumer too hard, too quickly,
Right.
they will walk, right? So it's how do we slowly bleed in all of the costs? That's why I started taking price so long ago, is to boil them like a frog, right? Because there's no way we're never going to give all of the price over to the consumer. Right?
Right.
Politicians still haven't figured this out. But that's just the reality.
Well, and it was fascinating to see the publicity around McDonald's, as well as, I don't know if there's Five Guys in here, but man, I felt bad for them in California.
There's more than Five Guys in here.
There is.
Yeah.
That's good, yeah.
Right?
Really good. But it's amazing.
I'll bring on more dad jokes.
I mean, that was really well done. You got to remember, we're finance guys. This isn't funny. But it's fascinating, right? Because you know what? They give tremendous value if you seek it out. But they were still, you guys still to this day, it's like, wow. It's fascinating.
James, I want to talk about, you mentioned, I think, in an earlier conversation about some savings with kitchen optimization. Like you changed a process, right? Can you talk about that?
So, look, I'm going to back up even further. First off, if you're managing your labor as a percent of sales, okay, you're going to lose. Okay, you have to manage labor as a productivity measure. Cosmo and I were talking ahead of time. They do, I think it's tickets per labor hour. Is that right?
Yeah, that's one of them.
Okay, tickets per labor hour. We do entrees per labor hour. Okay, so I can tell you off the top of my head exactly what it is. It's 6.2 entrees per labor hour in the last quarter. Why is that important? Is because as you start to tweak things within your restaurant, or as the price of minimum wage goes up, disproportionately up, 25% up, right? You need to know whether or not labor going from 25% hourly up to 27% is good or bad. Okay, you can't do that without productivity measures. Long story, wrapping it back to what we've done. We've done so much in the production side, things that the guests will never see. So what are some of those things, right? We've sat there and took a look at our chicken process at the stores, the original OG locations. If Armand's still here, he's probably not, is he? He took off already. In the OG locations, okay? You would sit there and you would go through a 45-minute process of brining chicken, debrining chicken, then slurrying chicken, then frying chicken. Horrific, not scalable, not transportable from region to region to region. So what did we do? We went and worked with our manufacturer to sit there and come up with a debrined or a fully brined process for the chicken coming into the stores. Okay, we've invested in equipment to help with the slacking process to make sure that bringing the chicken from frozen down to temp is done correctly so it comes out juicy every single time. That took half of our prep time out of the mix, literally half of it. Okay, and even with the little Dave's sauce packs versus the Dave's ramekins, okay, what we realized is that at our high volume locations, we had 2 staff members 8 hours a day filling little ramekin cups. Horrific. It's great for in-store experience to get that ramekin, but if you're going out of store and you're getting it to go, guess what? The sauce packets are great and acceptable, by the way. So we've continuously sat there and said, how do we create a meaningful labor model? Okay, and the one thing I'll touch on and I'll stop talking is, we've even gone to the point where, even cleaning crews, okay? We recommend cleaning crews. At my stores, I use cleaning crews because guess what? After 10 hours of working a shift, the last thing they want to do is scrub a toilet, okay? It's just not part of their, not part of a desired, effort, so.
I see Luke nodding your head a bit here. Did you want to weigh in?
It's just the drive to a productivity measure is something like lots of people have been using sales per labor hour for as long as time, and inflation has rendered that useless in most use cases. And just we see lots of clients really getting into the DNA of their business saying, what is the core driver of our labor deployment? And that's, everyone needs to have an answer to that question right now, because you can't optimally align peaks and better manage troughs and understand what good looks like across your businesses unless you have that true view of a productivity measure. So whether it's entrees, tickets, guests, items, I just see too many companies that don't have that data point now.
I'll just add on. I mean, we have such a wild range of average wage. In Houston, it's $12.50. Okay, try and compare that to $21. You can't. Okay, we did a case study that literally one of our Texas franchisees, we're like, you have opportunities here. He's like, look at my labor percentage. They were running 4.5 entrees per labor hour, but their average wage was $15.50. Okay, we pulled it apart. We literally brought them back $2,700 a week of profitability just on the labor line because they didn't realize it was there. So this is a perfect example of what he's talking about.
I want to talk a little bit about the future. I know you guys have just embraced this $20 an hour wage, and obviously wages are growing in other states. But the California Fast Food Workers Union is asking for wages to increase again in California to $20.70 minimum wage in 2025 and $21.40 in 2026. How do you both foresee managing future wage hikes? Do you just keep increasing menu prices? Cosme, you can go.
Yes.
But, and going back to what you were saying, you can't absorb, consumer can't absorb it all.
Is so much more manageable.
Yeah.
I grew up in San Jose. That's where I first got the beating. So, I just became used to like, okay, how do you deal with the initial slog and then dealing with CPI increases after? It's very manageable, right? So the consumer is going to be a lot more willing to accept the inline CPI increase than they would be, a 20%, 25% increase in your labor costs, right? So, I mean, that's just the reality, right? So we won't have to take as much price.
Yeah,
as long as there's no hyperinflation.
If you do the simple math, right, which is it's a 3% increase in wage on 20% of your labor, that's about 60 to 75 basis points. And then if you look at the, flow through of an incremental price increase, you're talking about 2 to 2.5%. That's it. So it's not that bad.
So
It's
you just
manageable.
keep raising
You got to
menu
keep raising prices, or you got to keep. I mean, look, we're never going to stop working the model. Okay, if you're not working your model on a daily basis, not just in labor but also in COGS. I know we're here with Harri, but you got to work it on the COGS side constantly, and most importantly, you got to work it on the COGS side that helps benefit labor. Okay.
All of it.
So yeah.
But what's the consumer reaction to that? I mean,
Consumers are going to
they're
pay, okay?
they're
And
just-
here's the problem, okay? The last time I checked, my 17 through 22-year-old aren't sitting there in the kitchen trying to order, fresh groceries from Instacart, okay? They're ordering DoorDash. It's just a reality of it.
Or the markups are even higher, right?
Yeah, I hope we don't have any DoorDash guys here, but
It doesn't
no.
matter. Well, we heard from Fred LaFranc earlier today that restaurants are resilient, and many of you all here got through the Great Depression and COVID. But are these current labor headwinds? Do you think you'll just have to remain resilient? That this is just kind of the way it is?
I mean, some will survive the impact and some won't. I mean,
Yeah.
we've already seen that, right? So,
The marginal players are going to continue to be marginalized. And it's unfortunate. There's some great legacy brands there. Ralph Rubio made an amazing brand.
Oh, yeah.
Okay, that was
Yeah.
that was a beloved brand, specifically in Southern California. So, yeah, I do expect more seats to be taken out of the restaurant industry. But you know what? There's the one thing that's great about our industry is you have creativity that creates demand. Okay, and if you're able to continue to kind of lean into the creativity, it's a beautiful thing.
I want to talk a little bit before we have a little bit of time for Q&A in a bit. I just wanted to ask a question because I do like everybody here who knows me knows that I love technology. Andrew Charles earlier today in one of the sessions said all signs point to a bigger reliance on AI and kitchen robotics. We've seen Steve L's debut Colonel, a fast food restaurant, using entirely automation to serve guests, almost entirely automation to serve guests. Sweetgreen is deploying its Infinite Kitchen. I visited a couple of Infinite Kitchens. They're pretty cool. White Castle is using Flippy as a fry cook. And Taco Bell and Carl's Jr. are testing Voice AI and many other brands at the drive-thru. So we talked earlier about kiosk deployment, but have you at all considered anything else like robotics to help with the labor pressures? And do you think that's the future?
I'm the robot right now. I mean, it'll eventually get there, right? I think, I used to be on the board of a robotics food company, and the technology just isn't there yet. It's getting there. Same thing with voice AI, it's getting there. Technology, I think a lot of us dream up of the solution today and don't realize the technical difficulty with execution. So it's going to take time. And not only that, there's got to be a workforce to actually service the robots, right? A lot of the ABB robotic arms, there is a shortage of technicians, right? There's I think 2-month lag on servicing the ABB robotic arms, which is what Flippy uses. I think we want to do it today, but it's not going to happen today. So in the immediate future, I think the answer is no, we're not going to be able to. In 5 years, 10 years, I think there will be significant penetration of those technologies into our establishments.
James, do you want to add anything?
No, look, we're testing it, right? We took the fry position because that translates from brand to brand. Like the chicken piece, it's a little more difficult, but the fry piece makes sense to us. So, we've got 2 versions of it in test. Well, one. We had 2, but this is a funny story. You guys got to hear this
Are
one.
you testing Flippy?
We're not testing Flippy.
Some other
But we
form?
had, and I didn't name these, okay, just so we're clear, okay? We had two fry testers where you have the frozen and you just load up the cases of fries, 4 cases of fries, it comes out, you hit a button and then it batches some fries. One of them they named Connie, okay? They didn't name her Karen, at least. They named her Connie.
Okay.
The other one they named Felipe.
Felipe.
Okay? So guess which one won? Okay? Unfortunately, Connie's gone. But Felipe is getting deployed into a couple locations. And here's what's interesting, right? It works at high volume, it works at low volume. It's tough to measure exactly, what the labor gain is on it. But I do know that's there, and I think over more time, it'll become more and more prevalent within our industry. But it's fascinating. We're testing out voice AI in the drive-through, so there's applications there, but it's tough, right? You can't just sit there and say, oh, it's going to work perfectly forever. It doesn't.
No.
Stuff breaks, okay? Yeah.
Speaking of break, I tried the Taco Bell drive-through voice AI, and I think I broke it. Like, I was trying to talk to it too much. I thought it was conversational. I want to hold a conversation with it. The human jumped in right away.
It was asking for a raise in a very subtle way.
Well, we have just a few minutes, so if anybody has a quick question for any of the panelists, raise your hand, please. Oh,
Don't
don't hurt yourself running,
Calling
please.
her the runway just.
So both of you guys talked about turnover, and I thought your guys' takes were really interesting, and I was hoping you guys could elaborate specifically on what you meant by it'll lead you to, you said a dead end, right?
Yeah.
Because as I see it, for us, the higher the turnover, the more time and investment I have to make in hiring, training, onboarding, right? And then not just that, it's kind of like it ghostly affects my bottom line because that's going to affect my order accuracy, that's going to affect my speed of service. So why is it that you guys are so concerned with having an industry low turnover rate?
Sure. So one is the organizing perspective, because our industry we're in the crosshairs, right? And labor doesn't really understand the fact that if you look at all of the industries that labor has organized, it's industries that have very high switching costs for whoever the consumer is. So labor doesn't understand those dynamics here, which it would cause, effectively our industry to start collapsing and people to start going somewhere else to eat, right? So that's one component of it. But, when you have stagnation in terms of, our industry is very, very mature, very mature. So you're not going to see a massive increase in employment, which means that there's not going to be a lot of people getting promoted. People tend to job hop significantly in very mature industries, and they jump to different industries, especially when the amount of skill that's required in the industry isn't that high. So the stagnation will be temporary, but what it'll cause is, it's like consulting firms. Right, consulting firms have, I'm looking at the consultant, have a tremendous amount of turnover at the lower levels. And what will happen is that turnover will embed itself into the reputation of our industry. So that's the fear I have from a long-term perspective. So I get in the short term the cost piece, which I also am very mindful of reducing it and managing it. But if people feel stuck, they're going to hop to another industry to see if they can get an increase, because everybody has, or most people have, ambitions greater than where they are today, including everybody in here.
All right, maybe time. Do we have anybody else who has a question? We're in the back.
Will
Hi.
you lower your interest rates to zero?
Oh, he knows.
No.
Oh, okay, sorry.
Richard Cable with Wells Fargo. Thanks for all the
He
topics
knew
today.
exactly who he was.
Yeah. And thank you for the fight you've had. I think we haven't talked much about it on like the political spectrum, but when you guys were fighting and being a lender in the industry, our industry was kind of under attack subtly as well, because the health of our customers and the brands is really tied to our success as well. So thank you for putting up that front. The only question I had was, given the higher labor and the connection with the prices going up and a lot of the marketing and stories on that, have you seen any of your front of the house kind of crew receiving any of the blowback from that directly, of like expectations of maybe a higher level of service, or like the connection that my menu price went up so their paycheck could go up, and like the expectations of that, knowing how it is a pretty kind of intense business from hearing folks and pleasing them, and how quick it is to kind of turn a customer experience?
You want to go?
Yeah, I'll take this one.
Yeah, it's
Softball, I love it. No, look, the industry as a whole, service levels have gone down, period, especially in California. So if you're able to execute at the same level that you did yesterday, last week, last year, you're going to actually be well ahead of the competition. Do I see, is there blowback? Yeah, there's always blowback, right? You just look at your customer sentiment scores and you're going to sit there and just Google price, right? Scrape price. You're going to see it over and over and over again. That's okay, by the way. as long as it's not driving the customer sentiment scores as far as the frequency of it, okay? There is absolutely a price point where some people are going to say it's not worth it. No big deal. There's other options for people.
One of the things we do, employees clock out, we ask them at the end of their week, have a good week, yes or no? And if it's, it can be yes or no or a 1 to 5 star score. And if we detect something negative, we follow that on with, what is it? Is it schedule? Is it training? And you give a selection of themes. And for the first time, we're starting to see a meaningful number of negative sentiment scores related to customer interactions, right?
Across the U.S. or just in California?
No, it is broader than California, and I've got to think, and we don't yet know, but that has to tie back to, I think, consumer anger around pricing. Right?
So I got to give Luke one big plug here because he's got a great vision for what is needed on the human capital management side, and his company has done a great job over the last 5 years specifically, really driving it. Specifically, what he's talking about is Harri Engage. It's something that we've been testing in our ecosystem because what our belief system, and I say our Luke eyes, belief system is that employee sentiment feeds customer sentiment, feeds sales growth. Okay, employee sentiment feeds customer sentiment, feeds sales growth. Okay, and he's actually created a tool that helps to quantify that piece of the employee sentiment. And I'll say, I got my first scores back a couple weeks ago, and my employee sentiment is 3.8. And I was like, oh, I suck. But when we started peeling back the levels of the onion on this thing, what we realized is that some of it was in our control, some of it was outside of our control. We had one guest that treated the employee poorly and they had a terrible day. Outside of our control. If we saw it, we would have addressed it directly with the guest and said that, go find another place. But some of it was in our control. Some of the employees weren't getting the hours that they were promised, right? So I do believe, I'm a strong believer that employee sentiment will be as strong as customer sentiment going forward.
All right. Well, I think that's all the time we have. I want to thank everybody for coming today. Thanks, Luke, Cosmo, and James. Have a good conference, guys. Thanks.